Is it possible to really make money day trading? Well, the answer is yes. The other answer is most people don't. So, operative word there being, is it possible? Yes, it's possible. Some people do it very consistently. Do most? Nope, they don't. Most people lose money trading. That's the honest truth, and I think we all probably know that. So, we need to put some things on our side in order to provide an edge over other traders that's going to put us in the top 10, 20%. And one of those things is volume. So today's a very basic presentation here today, but you know what? Sometimes the simple things are the ones that work. In fact, I found that the more complicated I make my trading, the less money that I make. And sometimes I've gone back to basics and then I've made more money again. And it's just been amazing. So, the one thing you have to avoid is information overwhelm. And boy, there's so much information out there and so much cool stuff and tools and indicators. And some of them can be even really good, but that doesn't mean they're going to make you more money. And especially when you start adding one on top of another on top of another, you get the law of diminishing returns. So my rule is to keep everything as simple as possible, but no simpler. That's actually from an Einstein quote who I don't believe was a day trader, although wasn't around, don't know for sure. Pretty sure he wasn't. So, but I like the slogan for trading as well. So we want to keep everything as simple as possible to keep our mind clear so that we can think clearly and have clarity in our analysis. But no simpler, because if you make things too simple, well, then you don't have a probability scenario. All right, so today we're going to keep things pretty simple, though, to just build a base. And then on top of this, you can add other things that you would like. But I think this is a really, really good base. So here it is, just using price and volume. And by the way, markets don't always move this nice, neat, and tidy, of course. But what I've got here is my 15 EMA. So that's what I like. You might like a different moving average. That's great. God bless you and the horse you rode in on. If you have another one you like, use it. I find this one very good. Started with a 20-period moving average a while ago. Well, many, many years ago, and actually just switched over to the 15. I find that it just seems to hug price more tightly over years of testing and data. So as long as price is below this, and keeps moving down, I don't really consider that a trend indicator. Just consider it a relative strength indication, actually. And so here we're above it. Here we dip below it, but we're still kind of going sideways. And then we finally get our move down with our red candles breaking away from here. Now, here's what I want to see is confirmation. That's just pure price action relative to a moving average. I want to see volume. All right, see volume right there, VOL. And volume, the reason volume is so important is that it indicates the strength of a move. How many people are participating? How much demand is there? How much supply is there? And remember, all markets really are the same thing. Their price action is based on supply demand. It's an auction place. So when the market's going in the direction we want, in this case a trend down, we want to see volume being higher. And so here we see higher volume. And then when does the volume come out? Well, gall darn it, it seems to come out right about there. Okay, now one other thing you'll notice is that the volume bars have some distinctions between them. Some are a little higher, some are a little lower. So we're kind of looking at the big pictures here. You cannot get too enamored by every single volume bar. Right, so it's more relative to the previous volume bars. So here we had a little lower volume, actually quite a bit lower. And here we have, if you just brought that across, then you could see, oh yeah, the yellow area is almost twice as high. So that's what we want. If we're going down, we want strength down as indicated by lots of market participation coming in. Then we've got ourselves one of them there retraces. Retraces back to the 15 EMA. Now, if we got a lot of volume coming into the market while it's moving up, they would indicate strength up. One of the questions I get, which is a great question, by the way, is, Barry, how do I know if I'm just going to get a short retrace and then the market continues down, or if this retrace is going to turn into a reversal and the market goes screaming up. And one of the distinctions you can look for is volume. So as the market, if it's just going to be a weak retrace up back to around the 15 EMA, again, we want to see that volume coming back into that lower area, that lower zone. All right, and that's what we've got here. So it's the same about here as here. And then as it comes down, we want to see it come down on strength again. And is it coming down on strength? Yes, it is. Now, you'll notice that volume is not a pinpoint accurate tool, or it's not an indicator, by the way. If anybody calls volume an indicator, they're wrong. It's not an indicator. Indicator points to something else. Volume is literally a statistic. It's how much volume, how many shares in this case, are going through the market at any one given time. It's not pointing to anything else. It's just telling you, here's the number. So, very important to, and some people say, well, volume's a leading indicator. There's times it can be, it's like anything else. There's times where it can be a leading indication, different than a leading indicator. I would never call it any kind of indicator. Sometimes it could be a leading indication, especially with volume spikes at exhaustion. That's where I would prefer to see it and maybe read it as a potential leading indication. But here you notice that it does not nail this high. If you wanted to go short here, see, I've got a cycle indicator that I use that's really just so precise. It nails these swing highs and lows to the bar, to the penny, to the pip, to the tick, and it uses momentum shifts, actually, is what it uses. If you want that, I'd be happy to share that with you. But volume doesn't do that. Volume, we still get some pretty weak volume here. It doesn't start really coming in until about here, which is kind of late to the party, but it does make sense. Why does it make sense? It makes sense because we're getting the breakout of this low. And this is where most people are going to feel comfortable coming in and shorting the market, continuing the short is here. Well, for me, that's too late. Now you're paying a retail. I rather get in here. This is where I get in. And I don't wait for the breakouts. So, but now most of the market participants start coming in, and then you notice it gets bigger and bigger and bigger. Okay, awesomeness. Now, what about this retrace? Do we expect this to be a retrace or a reversal? Well, the problem is, again, looking at the relative nature of volume, if we go all the way back to here, then we get some big spikes up there, and that's not good. We don't want to see big volume spikes as it's going back up if the trend is going to continue down. If the trend is going to continue down, we want a weak retrace, meaning low volume, like we had here. Okay, like we had here. Not like we have here. In fact, you could even go up a little bit higher than that to catch that bar. So this is not a high probability retrace for a continued downtrend. Could it continue down? Sure. Anything can happen at any time. We don't know. Things can change on a dime with news, gossip, rumors, whatever. But just purely trading price and volume action for these impulse moves, impulse move down, retrace. So we want strength in a downtrend. But the bottom line meta pattern is strength down, weakness up, strength down, weakness up, strength down, and then if we get strength up, then that's not a good retrace for a continuation to the downside. And that could be a little bit of a leading indication, if you will, and sure enough, up and up, it gets above the 15 EMA, and that's a pretty long retrace up. And well, now there you go. End of the day, and the next day it gaps down. Okay, but if you're day trading, then that's where we end, and that did not continue a downtrend. So there you go, a little extra basic stuff. But again, the basics, you should always have the fundamentals down solid before you add anything else to your charts. If you want to learn one of my favorite trade strategies called the rubber band trade, I'd be happy to share that with you absolutely free with all the rules, everything that I set up. It's really, again, simplicity. Love simplicity. Rubber band trade is very, very simple. And it's a reversion to the mean mathematical model. Happy to give that to you for free. Just click on the link below, or there might be a link above. Wherever you see a button, a link, we'll put it in the description for sure. Go get that. My gift to you. And I'm there to support you through it as well. Let's get you making some money before you spend money.